All right, thank you. Welcome everybody to this morning's webinar on what is equity crowdfunding and how to use it for your business. I'm really delighted to have expert Paul Niederer with us today. I met Paul years ago, and we developed a friendship, and also I see him as a mentor in this space. So welcome and thank you, Paul, very much
Thanks
for
very
the
much.
time that you're giving.
Thanks, Dion.
So firstly, we're going to talk a little bit about what crowdfunding is and how it can be used for entrepreneurs and also for people that want to invest. If we look at the different crowdfunding models, this is for those people who have not been exposed to it. We have social crowdfunding and financial return crowdfunding. And in the social crowdfunding aspect that's been around, we have donation crowdfunding and reward-based crowdfunding, which many times people have been exposed to Kickstarter, Indiegogo, Possible here in Australia. GoFundMe is obviously a very popular donation crowdfunding. And then there's financial return crowdfunding, which is peer-to-peer lending and equity crowdfunding. And so this is where Paul's expertise lies in with the financial return crowdfunding. So Paul, can you explain what is peer-to-peer lending?
Well, that's when, like, if you think of if somebody went to their bank manager for a loan to buy a car, that'd be the bank, and that's already aggregated lots of money from lots of depositors, and the bank manager is the one that makes the decision about the loan. But with peer-to-peer, it's directly between a person or persons that want to assist you and help you buy your car. So a platform matches you together, a bit like a dating platform or a Kickstarter or something like that. So you might have 5 people that lend you $10,000 at 5% or 10% or whatever the amount is, compared to 22% on a credit card.
Okay. And then the equity crowdfunding is what we're going to really focus on today. So Paul, before we go in and talk about the equity crowdfunding, what's your experience? I personally know it, but share with the audience where all your experiences in this space.
Well, back in 2008, when the financial crisis hit, a friend of mine was running a platform, an online funding platform, and we didn't know then that what we were doing was crowdfunding, but he called me in and said, look, things are a bit tough. Our revenues dropped from 400,000 to 80,000 a month. We've got 23 staff, including 3 lawyers. Can you come in, tidy it up, get the staff down to about 5 people, and then just move the business forward? And I thought, okay, well, I'll come in and do that. But I fell in love with the business. I fell in love with the opportunity whereby small businesses, without a lot of hassle and paperwork and that, can actually welcome into their businesses shareholders. And there was a unique piece of legislation in Australia called the Small Scale Offerings legislation that allowed people to do that. But it was effectively crowdfunding legislation, meaning from your own crowd, you could welcome investors into that. And that's morphed into crowdfunding legislation around the world, which basically enables people to invest in small businesses and become shareholders through an online platform if they follow certain regulations and rules that have been put in place for them. So it's basically the funding of the business by people that are not necessarily angels, VCs, banks, and things like that. They're just individuals that want to contribute in something that's often meaningful to them to support that person.
Fantastic. So that's a brief introduction of this what the equity crowdfunding is. Now, Paul, there's been a lot of legislation that's going around with this equity crowdfunding in the States. I think it was called the Jobs Act, and then most recently here in Australia. Can you tell us a little bit about how the legislation works, especially here in Australia?
Yes, well, I think that most people have followed the US, except the UK, in deciding that they need to build a new regulatory framework for crowdfunding and also attach it to the existing financial service operators in the market. So what you've got is a regulator and Treasury and the government have come together, and they did get a lot of input from the people in the country, people running platforms, but basically they drove their own race and created legislations that you have to have a financial services license. There are different parameters about nobody can invest more than 10,000 as a retail investor and things like that. So they've constructed regulations that they hope will be good for the market. But evidence has shown, even in New Zealand, that's got one of the, you could say, least regulated approaches to it, they haven't really got traction. And the UK is the only country that has really got true traction. And a lot of that's because they just allowed the platforms to develop in a type of a sandbox framework and build crowdfunding platforms that actually work in reality. Whereas we'll have to wait and see for Australia, but by the time people get their financial services licenses and have all the lawyers involved, if you want to raise $100,000, you're probably going to find that they, to get a raise up on the platform, they'll need 10 or 20,000 by the time you're finished. So it's going to be interesting to see that if the cost structure is going to be sufficient in Australia. I seriously doubt it. It will be compatible to small raises. I think you'll have to raise probably $1 million and above.
Wow. So there's a lot of reality checks with that. So as an entrepreneur, what are some of the pros and cons of using equity crowdfunding for my business? To look at it for a capital raise and to get it off the ground or to scale?
Well, often in the early stages of the business, probably if you've gone along to bank and you've shown them what your business is, it's difficult to get funding from a bank. It's difficult to get funding from anybody because they want to see runs on the board. They want to see credibility. They want to see that you've actually got turnover, you've got a product, you've got customers, you've got a projection, you're not too heavy on debt and things like that. And, for a lot of people starting out in their business, it's certainly not like that. So it's a lot easier to attract into your business people that are passionate about what you do, and they may not have the time to actually roll up their sleeves and be part of the business, but they've got time to put some money in. And so some of these can be like high net worth individuals. They can be cousins and aunties and uncles and people like that, can be mums and dads. But the good thing about it is that they fund your business and you can get going. The cons of it, of course, is that if it doesn't go well, then you've got relatives and people like that you've got to stump up to and say, look, sorry, it just didn't work out and you've lost your money, which isn't really all that much fun. But
in any case, whether I know them personally or not.
Yes, exactly. So that's the biggest downside of it, that if it doesn't work, if it does work, you are sharing your business with somebody else. But usually, like if you look at the ASSOB platform, out of 300 raises, the average was 20%. That you say give away, you don't really mean you gave away 20% of your business. What happened is people came in and invested 20% and got 20% of your business and you kept 80%. So as it rises and becomes in value, of course, if when they put their money in, it was only worth $100,000, that means that they put in $20,000. When it becomes $1 million, they get 200,000 and you get 800,000. So, it's okay because they've shared in your growth, and rightfully so. Just because you're the one that's got the IP, rolls up your sleeve and does the work and everything like that. The money is also something that greases the wheel of the business and makes it function. Without it, you would never have succeeded. And a lot of people don't look at it that way, that they're equal partners, the people that invest in their business. And sometimes they can contribute expertise and be valuable and things like that. So that's the difficult part. Some people sort of think it's like a passive thing and they sort of begrudge them in some ways after a while that they have to take investors in, but I don't see it that way myself.
Yeah. So that leads, there's a lot of work to construct your story and putting on a crowdfunding platform. I've discussed this in previous webinars just with reward-based crowdfunding, and we've had a few webinars on angel investing. It appears that this equity crowdfunding would be somewhat dumb money as an entrepreneur going after it, because if I'm going to do all this work to construct a pitch, if you will, why wouldn't I just go to angel investors and get what they say as smart money that could actually help open doors and provide mentorship as I'm growing and growing and scaling my business?
Well, businesses go through different stages. You know yourself with your work with angels that if they get 200 businesses, they might chop it down to 20 that they look at closely, and then they might fund 2 or 4. And it's those other businesses that really are the ones for equity crowdfunding, because the angels, often they're in a particular niche. often they've got a particular sum. They might say, well, we'll put 500,000 in if we can get 25% of your business or something like that. And so really, I think there's different stages of a business growth when crowdfunding works. And I think it's probably pre-angel is when it works best, or else when angels, the business is not considered appropriate for angels to invest in. And, you know, they are pretty choosy folks, and there's businesses that they won't invest in because they don't believe, often they think about it in terms of, is it going to be what's called a 10 bagger? And I think the 10 bagger means that if I put in $10,000, I'm going to get $100,000 back, something like that. And so sometimes for a business, it might not be that. It might be that it'll get 5 times your money back, you know, and so that's just how it is. And so then it becomes an equity crowdfunding opportunity.
Yeah. So as an entrepreneur, then it's probably not best to go, I have an idea, and to put it on an equity crowdfunding platform, because people wouldn't necessarily trust you because you don't even have any kind of traction. Would that be correct?
Yeah, well, I've got a matrix which I'm very pleased to share with your watchers and members and that. But I have 3 stories: a story, team, and what you call empathy traction. And I usually put 10 points in each thing. So story, you have to have a convincing, compelling, and credible story. And that's really, really important. And it is a big part of it. Like if you're at a barbecue and somebody says, oh, you wouldn't believe it, I'm just starting my own company and this is what I'm doing. Now, if you see their physiology change and they say, wow, sure, I'd love to be part of that, you know you've got a good story. But then you look at the team. What they're thinking, though, in their mind as they're looking at you, and as angels do as well, and some angels say they prefer to invest in the team rather than the story, which is really strange. But anyway, when they look at the team, they say, is this a capable team? Have they got the skills and capabilities to do it? Are they balanced? Like, is there the nerd and also the marketer? Are they capable, balanced, and credible? Are they credible people? You know, can I trust them? So you've got the story in the team, and then you've got what I call empathy traction. Are there enough people that in the world that truly think this is an amazing idea, something that they can get empathy with? And that's not enough, though, because to get them to put them in their hand in the pocket, like a lot of people love a great idea and they say that's fantastic, but would they put their hand in the pocket to fund it? And so that's the next thing, and that's what I call traction. It's that integral balance between empathy, loving something, and traction to put your money in to grow it. So if you take those 3 stories, and in answer to your question, if somebody comes along and they want to raise funds to say something and you say, oh, it's an absolutely amazing story, I think I'll give you 9 out of 10. The team is absolutely brilliant. You've got somebody in finance, somebody in marketing, somebody in design, somebody can do the programming. So I'll give you 10 out of 10 for that. Empathy and traction, well, it is a pretty local idea, but still, you know, it is, you know, there's a lot of people in our town that will really like it. So I'll give you 6 or 7. So you say, well, you've got 26 out of 30, 27. It's possibly going to make it. You've got to be up near that 27, 28, 29, 30 in order to really get something. And usually one area of what you're doing, sometimes it's an absolutely brilliant idea and you know lots of people will love it. But, you know, this guy, he looks a bit sort of like a con. I don't know whether he's actually going to do it. You know, that's the thing. So the team may be down, or the team may be absolutely brilliant. You know, computer programmers, and they know everybody wants a special Bitcoin blockchain type solution, and these guys can do it. But do they get the story right to convince people that it'll work? So that's the way I look at it.
Fantastic. I mean, I've always known about the story and the team. We discussed that even in reward-based crowdfunding. I like that term, empathy traction. And yes. I can understand that in reward-based crowdfunding and donation-based, because it's always trying to get people to give for nothing in return, especially with the donation-based. I didn't think about equating that to equity crowdfunding. So that's fantastic. I think that's an excellent takeaway for any entrepreneurs out there that are looking for this equity crowdfunding. Let's go to the other side. I'm an investor, and I heard that there's this equity crowdfunding platform, and now I can just go and search and look to see what's going to be a great idea, maybe to find that next Facebook online. What are the pros and cons from an investor's point of view going to an equity crowdfunding platform?
Yeah, well, often they're directed there by some impulse. Like I saw yesterday in Wholesale Investor, the first ICO listing was on Wholesale Investor. So I get an email, I see it, and I think, oh, wow, that's the first time in Australia. There's an initial coin offering is actually on a traditional investment platform. So I went and looked at it. I drilled down. I downloaded the offer document. Somebody rang me a bit later on. And so for me, impulses from the market take you towards a particular platform, and the reason for the platforms being is it's able to handle that interface between the person that it wants the capital and the person providing it. So for me, I didn't deal with anybody from Wholesale Investor. I dealt with people from the company, but the fact that I went there, requested information was wonderful, because otherwise, where am I going to find them? Like, there's millions of websites out there, and if they happen to have their website out there saying that they're looking for capital, how do you ever find it unless you've got somebody that is actually engaged with me with providing good investment opportunities? So I think the pros of it are very much that you get to know investment opportunities that have been curated, and they are of a certain quality, so that, you know, some of the work's already been done for you.
Yeah.
The cons of it are that unless you actually get to meet the people and sit down and have a coffee with them, often you don't get that visceral feel of, are they very real people? And I'm sure all of you have had in your lives the experience of seeing somebody on the internet and looking at things and all that type, and then you sit down and have a coffee with them, and your human brain that's been trained since the cave days looks and it processes and it sees whether or not these people are good people or not good people, or they're coming across in a congruent manner or not. And so some of those things you don't see through a platform. So if I was going to invest a substantial amount, and I'm sure it's the same for you, Dion, you would actually say, well, look, I like what I've seen. I've downloaded all the stuff. I've watched your videos. I was on your webinar. But can we have a cup of coffee? You know, I just like to get a feel of you. So the cons of it is that you don't get all of the human touch points you often need to invest. And I think it'd be a brave person if it was a substantial sum of money that clicked invest, sent the money in, and didn't really have any human contact in the process. Now, maybe going forward in the future, this will be different. If we look at the ICOs that are going on at the moment on the blockchain, then I think because the people have made a lot of blockchain money easily, there's a lot of blockchain millionaires, then they'll just shunt the money over to the latest ICO because they think it's cool. There's always a big play on the team part of it, the credibility. They've usually got about 12 people there, and they're lawyers and they're professors and they're Rhodes scholars and people like that. But so they try to pump up that team bit, because having a coffee with somebody that's sitting in California or India or somewhere like that is not that easy. So they build up that part a lot more. So, you know, that's just the cons, is that human relationship part of it isn't there as much.
And I guess one of the ways to mitigate that risk, and it's just like with any kind of investment, is what am I willing to lose? Because the percentages of businesses succeeding, especially into a 10X, is quite rare.
Yes.
So it's just another way of mitigating the risk.
Also, I think there's two different types of approach taken with equity crowdfunding. You have direct investment into the entity, which is like Equitize and ASSOB and Crowdcube and ones like that. And then you have ones like Seeders in the United Kingdom, where you invest into a group, and that group has one shareholder in there. And in some ways, that means you can often invest a smaller amount or lots of smaller amounts. And I think that the balanced risk, especially if you don't have a lot of capital, then I think it's better to balance your investment over several different things on a platform that allows you to do that. Just having everything in one company is relatively risky.
Yeah, that would be the example there that you share with Cedar. It sounds very similar to being part of an angel group, which we had a previous webinar on, getting into angel investing, as opposed to you being the sole person going, I think I like this company, I'll put my money into that, versus going to an angel group going, I like that company, I've never done this before, I'll put in 10 grand to this $100,000 raise and then kind of share the wealth with 9 other angel investors.
Exactly. That's exactly why they do that. Because then it means you yourself could invest. If you got 100,000 to invest, you could invest 10,000 in 10 items.
Yeah. So I pulled some logos up from the website, just like it did a really search like anybody else would do, equity crowdfunding platforms. And, just pulled a few, obviously, ASSOB, being familiar with that one. As somebody who would be from the outside, how do I evaluate which of these equity crowdfunding platforms are real? Because there's a lot popping up.
Yes. I guess the best way is to see how many raises they've had. I think that's the only way, is to how many successful raises have gone through that platform. If you take somebody like the ASSOB, it's probably about 320. Crowdcube, I think they've passed ASSOB now, or they're up around that number. Venture Crowd, they've had a few raises. They've also gone into different niches. Equitize had raises in New Zealand. I guess they're going to have them in Australia, but they've also had, patchy in some ways, having different types of raises. AngelList, of course, is a proven pathway to investment because you can invest alongside people like Ashton Kutcher and that. So it means that if he's put his money in, and he's usually in the know in some of these things, then, why not go along in a syndicate that he's involved in? So, so I think it's really to do your research on how successful is this company in the space. It doesn't mean that they've had to have lots of companies have listed on the stock exchange or anything, because it's early days. It's probably only ASSOB that's had 4 or 5 that have listed on stock exchanges. The rest of them are in early days. So you just have to choose based on looking back and seeing successful raises that have been filled. And you can see, what their track record's been like. If this is their second or third raise, then it's not so much about the platform, it's about the company. So then you have to, you can't blame the company because they're on a platform that's only had 1 or 2 raises, but you can do more due diligence, get to meet them, have a coffee, and do your due diligence outside of the platform.
Right. So I pulled this one listing up. Can you just, it's obviously from the UK, it's in pounds. So I'm looking at this, obviously they've hit their target. They've gone over 107% raise. So obviously we know how much they raised. What does this figure here mean where I see 11.95% equity?
Well, that's that figure when I said the average for ASSOB was 20%. That when you do your first raise, you usually, if you've got 1,000 shares, in this case, of those 1,000 shares, 119 of them will be for new shareholders. It's 11% of the total capital. So it means the company itself is retaining 90% of the capital. And so, I think if you look at it from an angel's point of view, they like to see, if a group of them come in, they usually like to get at least 25%. Wouldn't that be so, Dion? Something like that?
Yep. So if I'm looking here where I see 11.9% equity and there's 424 investors, does that mean that those 424 investors make up that, let's say, 12%?
Yeah, they'll share in it. And as you can see, they've also over-raised there 107%. So in fact, they'll have to issue more shares than what they were saying. But still, yes, 424 and 800, that means it looks like the average raise has been around £2,000 that have gone into that. Each shareholder has invested about £2,000.
Yep.
And for that, they'll get their share of that 12%. So it's 0.001% or something like that.
Yeah. Okay. Hopefully that gives our viewers a bit of understanding that when they come across and they see this, this kind of listing, that they have a better understanding. Now I did some research and I found an article that you spoke about, the breakdown of it. And so this was, you basically said in a sentence, so if I want to raise 600K in that sentence, you said 600K in 100 days from a gathered crowd of 1,000 with 60% local investors and over half retail or unaccredited investors. Can you just dissect that sentence for us?
Yeah, well, what tends to happen in a raise, like a lot of people think is, isn't it great if you want 600,000, you put it up in a platform, then all of a sudden all of a sudden you get one big investor that comes along, or two investors that invest the whole lot. But it doesn't work like that, because people, the people that are most attracted often to the offer, or the most appropriate, are people around the entity, and usually they're local. Like the statistics on ASSOB was that it was 60 or 70% were local investors that invest. Even if we had a listing from Sydney, and the most of the investors came from Sydney, so that's how it was. And then in terms of when you say retail and unaccredited, it means that, you know, in order to fill that offer, you might get a couple of big hitters in there that put in 100,000 each or something like that. But at the end of the day, the rest of it, just like you saw in that one we saw previously, over half, like you had 424 investors. It's probably Pareto's law. 20% of the money, 80% of the money may have come from a couple of big guys, and 20% came from most of those 424. But somewhere in all of that is going to be that you do need to get some larger investors, and then you fill it up with lots of smaller ones. And that's 60% of these local investors and unaccredited retail, mum and dads, people that think what you're doing is cool, people that want to help you and think, well, I want to be involved in this.
So before I put something, as an entrepreneur, before I put something on one of these platforms, is it best to have some people that have already said, look, put up on the platform and I will guarantee that I'll put X amount on, just to show that you have that bit of traction?
Yeah, Slava Rabin, who runs Indiegogo, he wrote a great article about this. And he says, don't put it up on our platform unless you know where 40% of your money's coming from. That's what he said. Don't even bother, because he says you're not going to raise your money. And he said that people have got this idea that there's leprechauns running around all over the place with gold buckets that just waiting for you to put your offer up there. So as soon as it goes up, and how they find it, he said, is beyond me. But all of a sudden that they're going to magically go to your page and start investing. But what happens is, on most of these platforms, if all of a sudden you open in the first 3 days, you see that 40% of the money is invested, you go to the top of the list, because the site they want you to be attractive. They want their platform to be attractive. Nothing beats things more than success. Then journalists write about it. After 3 days, they're 40% funded. And that in itself is sort of almost like a self-fulfilling prophecy. So that figure of 40% is the one that people say is pretty standard in the industry. Find out where you can get 40% of your money, drip feed it in the first 2 or 3 days, so it goes chung, ka-chung, 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 and then push out the marketing based on that fact.
Yeah, I tell the clients when I pledge all the time, like, please make sure that you have people that you can get to, because don't depend on our platform to fund your pockets. And they kind of go, oh, didn't realize that. And because if it would be easy, everybody would be doing it.
And you know, what it's really interesting looking at these independent, these initial coin offerings or token sales, because they have a PPS, a pre-sale, and it's not even up on the website. Then they have a pre-sale when it's up there, but it's saying a countdown 20 days till it goes till what they call the crowd sale. And so they've already had the pre-sale, which is to fund the marketing. Then they have the pre-sale, and then they have the sale. And by the time they get to the sale, they've got that same figure, 40% before the crowd sale starts has already come in. And so when they open, people know that if there's 20 million tokens, then 8 million of them are gone the day it opens. And then people say, God save us, this is popular.
Yeah, you need to be on it. So we just have time for a couple case studies. Can you give me a case study with your experience with ASSOB or any other consultancy where it was a crowdfunding platform, equity crowdfunding platform, that went south really quickly or bad?
Well, I remember once we had a brewery. And it was going to be one of and now when you think of craft brewing and everything, you think, wow, how hot are these things? Because I think on both Crowdcube and different platforms has been, and even I think Equitize, I think in New Zealand, but there's been raises of breweries that have gone very, very well. And they came in with this brewery, and they're going to get a German brewer to come out to Australia, and they're going to have this big copper thing, and it was going to be, really a classy sort of a thing. And, I myself thought that that sounded great. I'd like to invest in this. But they had this idea that they also wanted to make it a brewing resort. So around the brewery, they were going to build a resort. They were going to have a petting zoo and a kids' play area and everything like that. And so we said to them at the time, well, look, any offer, any raise has to be easily digestible by somebody. They have to understand what it's about. Brewery, good. Resort as well, a bit of a mix of investment types. People know resorts take maybe 2 or 3 owners before they become profitable, things like that. There's too many mixed up messages. But, they were determined to just raise it for the resort and the brewery. And then when they opened, they didn't get any investment. And, you can't say, I told you so.
Yeah.
And what I often used to say is that your story has to be simple enough really to be able to be explained to a guy with a dog and a ute and an ABN number, right? So that means if you tell him that story, like if you say, look, I got this German brewer coming out from Germany, and he's adapted a special beer for Australia. And we're not only going to bring him, we're going to bring all his equipment, his copper things and things like that. And every Friday he's going to have a shareholders night when you can come along and you can drink as much as you like. Would you be interested in that? And then, of course, they'll say, well, God, yeah. But if you said to them, we're going to have different holiday types and we're going to have for the children to play, and it gets too complicated. So
yeah, so the whole thing about keeping it simple is very paramount.
Yes, it is.
Yeah. And let's finish off with probably your best experience of equity crowdfunding raise on a platform.
Yeah, well, it was coincidentally one on the ASSOB platform, and it was the early days, and it actually pretty much made the platform because we'd had lots of raises, but we hadn't one that hit the headlines. And it's one called Pressure Food. And I guess if you go into the supermarkets today and you see the drinks are in a triangular bottle, like a triangle.
Yeah.
And the reason why that is because instead of boiling all the goodness out of the fruit juice before they distribute it, they put it down to the same pressure at the bottom of the ocean, and that pressure kills all the bacteria and bugs, but keeps the flavor and the nutrients intact. And the chamber that you put it into the thing was shaped like this. And so the bottles fit in there so they could push it in there. Now, of course, that's a good story in itself because basically a lot of the juices you get have had all the goodness boiled out of them anyway. And so, this was a good argument from the side of that you actually got good quality juice. But they just, in the middle of the raise, which is what we call like a compelling event, they won the best new world beverage in Germany for the World Beverages thing. So that just came out. And a story happened to go on to Business Sunday on the ABC. And that Monday and Tuesday of the next week, over, I think it was nearly $3 million was sent in to invest. Just like that, a whole lot.
Talk about perfect timing as well.
It was perfect timing. The problem with the legislation was, though, that at the time you could only accept investment from unlimited, sophisticated and professional investors and overseas investors, so they could take all those ones. Yep. But a lot of this money that came in was from retail investors, and you could only accept 20. So by the time you'd chosen the 20 that you wanted to accept, and obviously they were the ones with the larger amounts, the rest of the money had to be sent back. But still, they still got like $1.5 million what they're after, and the money came in. But what it showed me was that, the story came across very clearly. There was a really good team, and not only that, they were recognized at a conference overseas. And the empathy and traction, there's a lot of people think it's a good idea to get a new drink, but when it went on TV and it was more legitimized, it moved it from that empathy to that traction, and then the money came in. So it was a great idea of the model that I developed to assess opportunities that maybe don't have the numbers or the assets or the things to support it.
Awesome. Well, look, I want to give a big thank you to Paul and his time and his insight. I always love speaking with Paul because I learned so much from his expertise. There's his website, and if you have any more questions, you can go to his website. I'm sure you can look him up on LinkedIn, and there's my details with Wise Academy and also iPledge. So once again, thank you very much for your time, Paul, and your insight. And I look forward to speaking with you and everyone again soon.